Gather around, financial mutants. We're going to do a deep dive on some popular investment strategies.
Brian, I am so excited about this show because there are so many investment strategies out there. If you're out on Twitter or TikTok or you're reading blogs, there are all kinds of people that are saying this is the right way to invest. This is what you need to know. This is what you need to do. This is how you are going to build wealth. And I don't think that we've done, at least not recently, a deep dive into some of these various investment strategies and whether they have merit and there's something you should consider, or is it a bunch of hogwash and you ought to ignore it altogether?
Well, we are, I try to make everything as easy as possible on your wealth building journey. And sometimes I feel like because we've focused on making it easy by talking about passive investments, index funds, even index target retirement funds, that people have thought that we've fallen asleep and aren't going into these deep dives. But no, it's really the motivation of what we want you to accomplish through our financial order of operations system, through making sure you know what to do with your next dollar. But I think it is important because there's so much noise out there in this great modern world we live in that we have so much coming at us. We ought to at least share some of these common strategies you might see out there on TikTok, Instagram, or other places, so that you can actually know how does this fit into your portfolio and your investment philosophy.
And so what we've done is we've tried to go grab some of the most popular ones. And the first one we're going to talk about is one that if you are in investing circles and if you've been investing for a while, you've likely come across this. It's this idea of factor investing. Now, factor investing is just a process of choosing investments based on specific factors that are believed to be associated with higher returns, such as smaller stocks or those that are undervalued when you look at the PE ratio. Here are some common factors that people think about: company size, growth, valuation, profitability, historical performance, leverage, liquidity, momentum. It makes me think about, Brian, I'm not like a huge sport. I like watching sports, but I've got those buddies that they're all into recruiting and they will look at specific attributes. Oh, this guy, man, he's got an arm and it's a cannon. Or this guy, oh, he can shoot threes. It's kind of like selecting your investments with that. What's the special thing that this holding can do that because they can do that, it's going to outperform long-term? And because there's some unique trait about it, it's going to be a factor that's going to lead to better performance. And I think a lot of people are thinking of looking into that super deeply.
Well, I got to think, because you laid out like fantasy football, you laid out sports and other things. Surely there's more to this than just the gut feeling that this month we're going to focus on momentum, or this month we're going to focus on liquidity just because the banks are struggling. I know there's research and there's other things that have gone into this. Can you give us a little deeper dive on that?
Yeah, so factor investing is popular because we go through economic cycles where different types of assets perform better than others. Here's a really, really easy example. If you look at the last 12 years, and you're just looking at U.S. large cap companies, and you picked growth as a specific factor that you were going to utilize, U.S. growth companies, or U.S. large cap U.S. growth, has outperformed large cap U.S. value to the extent of 400% relative to about 265%. So if that were a factor that you had honed in on for the last 12 years, you would have outperformed. You would have been pretty happy about that. But you can see pretty clearly, if you were someone who thought value was going to be the factor that you should lay onto, maybe you would not be quite as happy as those growth investors.
But the question I have is, because I see this and we see large cap growth value. I know also, the data started here in 2010. We'd come out of the Great Recession before this, where we had the boom, and obviously so much has gone into innovation. And we'll talk about that when we delve into dividend investing and so forth. But I know that people, when they're talking about factor investing, it's not typically just large cap growth versus value. There's a model, and I like to say FF3, and we're not talking about Fast and Furious Tokyo Drift. What is FF3?
Yeah, so there were two University of Chicago professors, Eugene Fama and Kenneth French, that developed the Fama-French three-factor model. And what they did is, using specific research that they had conducted, this was back in 1992, they found that if you could look at company size and historical performance and then book to market valuation, and you just focused on those three factors, and you selected companies that satisfied those three factors in a specific way, you would be likely to pick outperformers moving forward. And so, according to the famous French model, you look for smaller companies that were undervalued, that means lower price to earnings ratios, that historically had outperformed the market. So there was some momentum behind these companies. And while that sounds great, if you actually look at this, let's play this out practically. If you're looking at small companies, low PE, that historically outperformed, you guys have seen this illustration a lot. This is the Callan periodic table of returns, and it shows a number of different asset classes, and they're all color-coded. And this shows the last 20 years from 2003 all the way till 2022, and how each of those asset classes performed relatively. So you can kind of see how the colors bounce around. Well, if you were to implement this famous French three-factor model, you would have had the green line performance. And what you can see is it's kind of like an EKG. It's like way up and way down. And there are some years where those specific types of companies were really strong performers, but there are other years where maybe they didn't perform as strong. It's this pretty volatile ride. Well, when you lay over that, just the broad market, just looking at US large cap equity, the boring market that we think of, S&P 500, you can see that from a trend standpoint, it kind of moves in the same direction, but it's much more compact. The yo-yo string isn't as long. And so the question becomes, if you just implemented this famous French three-factor model over the last 20 years, would you have been better off because of it? Would the factors they pinpointed have been the ones that actually caused you to outperform? And it's really interesting. U.S. small cap stocks over that time period performed about 9.4% on an annualized basis. U.S. large cap performed 9.8%. So the large cap companies, the boring old market, actually outperformed. And what I think is wild is for most investors, that ride would have felt so much smoother. From a psychological standpoint, you wouldn't have had these wild ups and downs like you did in the small cap portfolio.
So we'll get to this a little bit later when we talk about the Money Guy flavor on how you actually bring this into your investment philosophy. But what I find interesting is that when people go all in and they say factor investing, I look at a chart like this, I think of modern portfolio theory where I don't want it to be an either or. I actually like both of these. I like small cap investments in my portfolio. I like large cap investments. Why don't we do and instead of either or? And that's something that's very interesting. But I love the thought that when, like I said, when academics and researchers and others get together and they are trying to come up with a better mousetrap, I'll just be curious to see if this is the way you should actually implement your investments.
So if I'm someone out there listening and I'm hearing this, I'm probably asking the question, well, why do people do this? Why do people do factor investing? Or if there are these really smart professors who say this is the way to do it, why don't people do that? Well, it's kind of in line with what you just said. Not all factors or segments of the market offer the same risk-adjusted rate of return. If I pull off the chart, if I pull off the lines, and I just show this chart again, and you just kind of like zoom out, it's probably so small you can't really read it. But if you look, it's not uncommon for some segments to be top performers, and maybe even top performers for a number of years. But then you find that in the very next period or the very next group of years, they're underperformers. The one that I like to point to is kind of like that yellow, orangish emerging markets. There are seasons where if that's the factor that you're honing in on, you're going to feel like you're a genius. You've got it all figured out. But then there are seasons where if that's the factor that you're trying to hone in on, you're going to be like, what in the world did I do? Holy cow, how could I have been so wrong? And you said it best, Brian. I don't think that when it comes to factor investing, I don't think it's an either or. I think it's a both and in terms of how we do factor investing.
Well, I don't want people to be reactive with their investments. It's just like right now we know there's turmoil in the banking sector.
Yep.
So you heard us say one of the things you could focus your factor investing on is liquidity. So a lot of people might be thinking, hey, let's go ahead and run a screen where we pull out any type of things that struggle with liquidity, cash, and other things because I want to protect myself from any type of volatility of that. Well, the problem with any of these plays is especially if you're reacting to the current events of the financial world, you might be missing out on because the opportunity of a lifetime. Because a lot of times people, the maximum market opportunity to invest in something is when everybody else hates it.
It's when they're running for the exits.
I mean, and that's the part that I get nervous about is because you look at in the past, like with the Great Recession, if you ran a screen to make sure you excluded different sectors, like the financial sector after the Great Recession, or maybe after the dot-com boom, if you ran a screen to exclude technology from this, you might be getting yourself in a pickle in the long term, because some of those components that seem desirable or least desirable at the time might turn out to be your best performers over the 10 to 15 year long-term window. And that's just something that I'm not a load up on one strategy. I'm more of a diversifier.
And so what's our flavor when we think about factor investing? Well, factor investing in the academic sense relies upon the belief that future performance of a stock or of a holding can be determined by historical quantifiable factors. Well, we all know, if you've ever watched anything investment related, there's always this disclaimer: past performance is not indicative of future performance. I just don't know that it works so cleanly. Just because something was the top performer yesterday does not mean that it's going to be the top performer tomorrow. And so when you really boil down into those that are like true blue factor investors, like they are picking factors and betting the farm on it, it's really technically a form of active investing.
Yeah, and you see people run concentration strategies and so forth. I always get nervous because I've told you guys I believe in the great big beautiful tomorrow and the law of accelerating returns and innovation and disruption. And there's going to always be ways for you to invest and take advantage of this ever expanding economy. And look, that's not just off of a feel-good feeling that the world's getting better and I'm a natural optimist. It's also because when you look at the performance of the large cap investments over the last 10 years, 93.1% of active managers underperform just buying the index. So there's a lot of calories being spent, a lot of energy trying to figure out the next big mousetrap to get ahead of the curve and everybody else. When I'm just telling you, guys, we live in the greatest time with the greatest innovation. Just buy the market and you're going to be rewarded for it.
Yeah, I think you said it perfectly. Factor investing, in our opinion, is not so much an investment strategy as it is a portfolio design tool. Because when we design portfolios, we're all trying to think about what factors do we want to utilize. Are we going to invest in large companies or small companies? And how much are we going to do that? Are we going to invest domestically or are we going to invest internationally? And how do we decide how to split that up? The real gripe that we have with factor investing, and specifically those folks who are out there touting it so strongly, is how granular you get with the factors. Like, I'm just going to invest in this very specific set of companies. How hard you really bet the farm on any one factor because you feel like you have it figured out, and how confident you are that the factor that you have uncovered is the one that will deliver future performance. Because what's really, really frightening is that statistics and numbers and graphs and charts can be a little misleading. And if you don't believe us, look at this chart right here. This chart shows an overlay of the consumption of margarine from the year 2000 to the year 2009 and the divorce rate in Maine. And what you would be able to conclude from this illustration is that so long as less margarine is being consumed, people in Maine will be getting divorced less. Just because something is correlated, just because something can move in tandem, doesn't mean that there's causation associated with that. So just because you uncover some factor that did perform well, or two factors that are related that performed well and were highly correlated, does not mean that one caused the other. So I think people can arrive at very misleading conclusions when it comes to factor investing.
Yeah, I just want you to be open to expanding your toolbox to where you're not just a hammer looking for a nail, that you will consider, using large cap. You will consider using small cap. You will actually broaden beyond just where the factors that at the moment might be yielding good results, but over the long term are probably going to moderate and reversion to the mean, as we like to talk about. So don't get caught up in those trends, the hypes, the other things, when it just might. It's not saying that factor investing is wrong, but it's probably just one component of a much bigger thing that you're doing with your investments, with your asset allocation.
All right, Brian. So we talked about factor investing. Let's talk about another one I think that is like wildly popular. Even as we were talking about this, some of the people in the live chat were saying, man, I hope they mention this one. I hope they talk about this one. I hope they say something about this one. And this is one, again, if you are out there on the interwebs, you've seen people touting this. It's dividend investing.
But give them the definition of dividend investing, then I want to kind of give a little context or something I find interesting.
Yeah, so dividend investors, they choose to invest primarily in stocks or funds that return cash or pay cash, known as dividends, back to shareholders. So they're looking for holdings that will return cash or capital back to them on some periodic basis through time.
I think it's interesting because I see how we fall into this, is that dividend investing is kind of fun in the fact that it is a positive action, meaning a company is giving you money. And then if you're a lot of dividend investing, you can either reinvest it or you can just keep it in cash. Typically, somebody who's closer to retirement will probably keep it in cash and use that as kind of an income source to cover their expenses. But a younger person, a lot of times you see them reinvesting and they get so excited because it does feel good. This company paid you money, you bought more shares, so you've got the positive action of buying more and growing. You've also got the action that you receive something and there's this implied contract that's got to be a good thing because you got more than you had before. But guys, I got to tell you, this is not the rainbows and unicorns that a lot of people are playing, especially if you're a young person. And we kind of want to walk you through the details of this so you can understand how this could still be a valuable tool in your portfolio design, but don't lose the plot.
Yeah, you just said it. The brochure for dividend investing is so exciting. I can get capital now. Maybe the company is going to increase it. Maybe because I'm buying dividend paying companies or holdings, it's going to be a little bit less volatile. It's going to be a little bit less risky. The problem that we find, though, with dividend investing, in our opinion, is that folks who are so focused on that, we worry that perhaps they miss the forest for the trees. They have a hard time seeing the big picture because they're so focused on the small picture. And the content team did a fantastic job while you're out, Brian. They found this tweet that I thought was just wonderful.
I thought it was satire. I did not take this serious. Y'all claim that this is serious, but I thought it was satire.
So really quick, I want team to create a poll, and I want you to do an option A, option B. Do it real fast, Daniel. I'm going to talk slowly so you can get it going. So here's what Side Hustle King lays out. Would you rather get paid $1 million right now or $50 every month for the rest of your life? That's the question that we're asking you. Let's do a poll, see which one you would choose. This is what Side Hustle King said. I'll take option B. That is what passive income is. Find a way to make passive income and it will change. It will change your life.
Well, because it feels good getting money every month.
Good.
It feels like
great.
But I mean, am I supposed to talk about it? Because when I saw this, I was like, "This is not real. There's no way this is real."
You don't think there are people? So in case study, like we went on the street and we started asking people, "Hey, I'm going to give you a choice: $1 million today, $50 every month for the rest of your life." And they're like, "Oh," and what's funny is the young people, right? They're like, "Oh, I'm 21 years old and I'm going to live until I'm 100." Oh, surely the $50, right? Like that again, it's this idea of thinking about that. They're missing the forest by focusing on the trees.
Now, let's just go ahead and blow this up because this is something that I immediately, when I was looking at this, I was like, the reason I think this is satire is right now we know you could easily get 4% on your cash. 4% on $1 million, you get about 40 grand a year. 40 grand divided by 12. We know that's going to be well over $3,000 a month. So if you're doing that, $50 a month is only $600 a year. I mean, we'd blow past this in just a week or two. So it's one of those things where, and it's not fair to group dividend investing into this tweet, but it is one of those things where I think it is young people especially I want to make sure you're not taking the positive behavior of receiving something and then reinvesting it as the absolute, and you're missing the plot of how do you build long-term wealth, get wealthy and then stay wealthy, and the strategies that will support that in the long term.
So here's what we think about dividend investing. Here's the very first thing. When it comes to investing, we like to focus on both components of return. Income component is a singular component. There's another component of return that's capital appreciation. I buy something today and it's worth something tomorrow. When you only focused on income, when you only focused on yield, when you only focus on dividends, you're kind of saying, okay, I'm going to put out of sight, out of mind the thought of appreciation. Well, you're getting rid of half and oftentimes more than half of the equation. So we think, just like factor investing, dividend investing is often too singularly focused, where the outcome that you hope to achieve would be more easily attainable were you not so laser focused.
Well, also, and this is coming from my public accounting background, I know how inefficient dividends are from a tax standpoint. It's because I don't know if a lot of people realize this, because we just take it for granted, is dividends first have to go through the corporate taxation system, meaning the companies that are paying you the dividends, they're going to pay the payments they give you as a dividend is after they've already paid income tax on it. It's not like they got a deduction for giving you this dividend. And then you as the individual, when you receive the dividend, you will also then pay income tax on that money that comes in, assuming it's in a after-tax account. Now, look, the government's tried to mitigate this a little bit because, the corporate tax rates have come down with the legislation back in 2018, the 2018 tax reform. We also have seen historically that dividends are taxed at a lower rate. And we all think that that's great. And it's once again another benefit to the investor class. But really, I think it's a matter of trying to lower the bar of the double taxation that's occurring when companies are paying taxes on the distribution, and then the individual is paying taxes when they receive it in their taxable accounts. This is not tax efficient.
It's not tax efficient at all. And then another thing, and we talked a lot about this in pre-show prep, Brian, is that companies that pay dividends are in essence making a decision about how they want to approach capital allocation. And they are deciding that this money could be better utilized going back out to shareholders than we, the company, keeping the dollars and reinvesting. And you had an interesting take on this and some interesting thoughts around, is that a good sign for a company or a bad sign of a company, or it could go either way?
Well, there's two things. If you were thinking of hanging up pictures on your wall of great innovators, great investors, two people you want to think about is like Warren Buffett.
Yep.
Warren Buffett does not like dividends. I'll just go. If you want to know, go look up the dividend history of Berkshire Hathaway.
He does not like paying dividends.
Well, he does. He does. It doesn't. It's not part of it, because I think Warren would say, I am much better if you give me the money and let me allocate where that money goes. I'm going to be better than the government. I'm going to be better than you, the individual. I would rather keep this money for purpose. And that's a great segue into the next thing. I look around the room. And then I took it out of my pocket because I don't like to have it. But I start thinking about a company like Apple. And we all know the history of Apple. So, Apple was founded by the two Steves. You got Wozniak, you got Jobs, Steve Jobs. And then Steve Jobs gets kind of run out. And I think it's so interesting that if you look at from 1987 to 1995, Apple paid a dividend. And during that period of time, the stock actually went up 108.6%, or about 9.63%.
Not too bad.
Annualized.
That sounds pretty good.
But that sounds great on an annualized basis. But we all know Apple was struggling. And so much so that they looked around, they go, oh my goodness, we have gotten ourselves in a pickle here. Can we bring back the guy that kind of brought the magic? And so they brought Steve Jobs back into the equation in 1997. And I think it's so interesting that if you look, because they had to suspend the dividend in 1995 just because the company, from a financial standpoint, just couldn't support it. But then you did not see a dividend from 1995 all the way through 2012. And what I think is interesting, we all know, sadly, Steve Jobs left this earth way too soon. He passed away in 2011. And what happened from that period of 1997 all the way through the Steve Jobs era of the late 2010s, and we have the iPod that has changed my life, changed your life because you're watching our content. We've got the iPhones have come on the scene. We've got there's so many things. The Apple Watches that we all of us nerds walk around with, and a lot of those original ideas came through innovation. They came from somebody who said, I want to keep this money because I want to throw it into research and development. I want to come into, there's a better way for me to expand and grow this company than just issuing out a dividend. And that's why when you look at the annualized performance during the Steve Jobs era, you quickly see that it had a rise, an appreciation of 4,101%. That's not a misstatement, or an annualized performance of close to 25%. That is very valuable in understanding, is that, because I look at it as a sad statement. When I saw that that Apple was going to start reinstating the dividend after Steve Jobs passed away. I was like, man, that's kind of sad. And
Makes me think of ideas.
Well, you see the same thing when Microsoft added it and others. It's because it means they are basically implying the company is so mature now that we have more cash than we know how to deploy, to grow, to expand, to innovate. We're just going to give it back to the investors, which is great, but it's also sad because it's just realizing that the company's in a different place now. And that's why you don't see companies like the Teslas and the others that are still in that innovation phase. They're keeping the money because the money's a resource that's going to fund the next expansion phase.
You actually said something also that's another sort of problem or issue with dividend investing is that it can be unreliable. Imagine if you were someone who was investing in Apple because you wanted the dividend and you needed to count on that for the income, and then all of a sudden the company changes policy and they just stop paying it out or they reduce the dividend, and now you're thinking, oh man, okay, well where's my income going to come from? Where's my cash flow going to come from? Just because a company is paying a dividend does not mean that the company will continue to pay a dividend. It does not mean that the company will increase that dividend. So it's not something that is set in stone. So if you're banking your entire retirement on dividend income to be coming to you, you might be taking more of a risk than you recognize. And that's another point that you brought up.
Well, it can lead to overconcentration. I can tell you I had so many meetings with families where great-grandma bought Coca-Cola or the great-granddad was on the board of some new bank that's started in the community, and they start paying these huge dividends that the whole family is just taking this cash every year, and they're assuming that this will be their retirement. And then you know the rest of the story. I mean, we're right now dealing with a banking volatility play. And so anybody who was excited about all the income or dividends or and the yield that they're getting from those type of perceived safe investments right now are feeling like the carpet was pulled out from underneath them. So just be careful, because that concentration, it's like all sins and all things. Is it something that can be a good thing? In too much concentration actually takes away from your overall health and success and actually can be a detriment to you. And I feel like the same thing happens kind of with dividend investing to a degree.
And when we think about, you had already mentioned, there are these two components of return. There's the income component and the capital appreciation component. Because you may be singularly focused, there's a good chance that dividend stocks may not just outperform the overall market. If you look at dividend payers of the S&P 500 from 1973 to 2021, just the companies that pay dividends, they've annualized about 9.6%, which again, is very strong. That's a really solid rate of return. But if you look at just the overall S&P 500, just the broad market itself over that same time period, it annualized 11%. So what does that tell you mathematically about what those non-dividend payers must have been doing from a performance standpoint? If 11 is the average, they must have been performing greater than 11% to bring the average up there. So if you're only focused on dividend investing inside of your portfolio, you as an investor may be leaving a lot of return on the table that could help to sustain your long-term retirement portfolio.
I don't want people to miss here, because we're such optimists, but I feel like we sound negative on dividend investing. I'm not actually against dividend investing. It's like, it's no different than the same behavioral stuff when I talk about prepaying your low-interest mortgage early. It's a time and place type discussion. Is that I think if you're a person who's quickly approaching retirement or even in that phase of retirement, yield is important because you are trying to create income and other things to cover your living expenses. What I get frustrated with is young folks who are in the be wealthy phase of their life or create wealth phase of their life, and they're focusing on something like dividends prematurely, and they're losing the plot in that aspect. That's what I want to kind of draw light with this discussion, is that this, once again, is another tool that you will find very useful in the crafting of your entire asset allocation. But don't get so excited about this newfound thing or this new tool that you have that everything feels like it needs to either be screwed in with the bit or hammered in if it's a nail, because we find out there's a lot of different uses that you want to have access to it all within your investment toolbox.
All right, so let's talk about a different one now, because naturally folks are, okay, guys, I get it. You've talked about factor investing. And I get it that you talked about dividend investing, but I'm well read. And I exist out there on the forums, and I've heard about a thing I think is a great solution for me. And I want to know, what are your takes on this thing that was popularized in the Boglehead Forum called the 3-fund portfolio? And quite simply, a 3-fund portfolio is typically comprised of a domestic total market fund, an international total market fund, and a bond total market fund. 3 broad asset categories. You buy different proportions based on where you are, set it and forget it, and that's what you do. What do you think about the 3-fund portfolio?
What's interesting is this is kind of like lazy investing.
Yep.
And we've done shows called Lazy Investors Win and so forth. So once again, we're not against this strategy either. I do think, though, that this is bumping right into when we talk about we love index funds. And you mentioned this is kind of originated from Bogleheads, which is synonymous with Vanguard investments. People will get so excited about this, but there's still a lot of things that are missing on this, Bo, is because just because you just gave out 3 things. You gave out domestic, you gave out international, and you gave out bond.
Yep.
When I was doing research for today's show, it cracked me up because I have not seen somebody trying to say this is what you ought to use. On one of the blogs, somebody was trying to give insight on how you figure out how much bonds you should have in your portfolio. And they brought up the age, way where you can, the older you get, obviously, the more bonds you're going to have. But it still could way overstate how much bonds you have. And it's the complexity of how much large cap, how much international, how much bonds. There's still a lot of question marks about that. This is simple, but it doesn't actually help you with the complete execution because you have to figure out how much you're going to allocate to these 3 low-cost investments.
That's exactly right. We love that a 3-fund portfolio in its simple construction is low cost. Because they're index funds, it can likely be super tax efficient, although not the most tax efficient. I'd argue there are other more tax efficient ways to do that than the 3-fund. And it doesn't involve stock picking. You're not having to go out there and pick winners and losers if you are doing index investing. However, you still have to make some decisions. When it comes to the 3-fund portfolio, you have to decide, okay, how much do I like fixed income? How much do I like total domestic? How much do I like total international? And psychologically, you have to have the staying power. If you come through a decade where maybe international underperformed or it wasn't tough, how do you fight the emotion of saying, oh man, that one's been a dog, I'm going to get out of that? And then do you not just find yourself in the place where now you're just trying to time it? Okay, well, what's going to be the hot asset class for the next year, 2 years, 5 years, 10 years, and which one should I avoid? And you start squeezing the balloon inappropriately. That's why we think rather than the 3-fund portfolio, we think there's a better solution for folks that are in that stage of their investing career.
Yeah, I mean, well, it gets back to, you've heard us. I mean, because we go through the progression when we love index investing because it's low cost, it's tax efficient, there's a lot to be cheered on, and then, but we know that only gives you the what do you go out there and look at? You look at index funds, but then how much do you buy each thing? And you're like, well, that depends upon your age. That depends upon your goals. There's so many risk factors that go into it. So when target retirement funds came on the scene, because when I hear about the 3-fund portfolio, Fidelity forever had because I loved index investing, and then Fidelity had the Forum 1 index.
That's right.
That was like, because this is before target retirement funds kind of started getting traction. And I sent a lot of people to that type of simple investment, but the problem is it didn't rebalance. It didn't give any difference between a 25-year-old who bought it versus a 48-year-old who bought it. And then here comes index target retirement funds. Now, all you trolls, I said index target retirement funds because I still want to get that tax efficiency. I want to get that low cost, but I love the simplicity of just saying, how much can you save? When do you need it? And then this does everything else for you, because we all know that your investment path is going to change. When you're 25, your needs are different than when you're 60. And that's what we're talking about when we say that difference exists, is what's called your glide path.
That's right.
And Bo, that talk about, we put up a slide. This is from Schwab, but this does exactly what what I just explained.
Yeah, rather than you having to make the allocation decisions, a really good target retirement index fund will make the allocation decisions for you, really aggressive while you're young, and then it'll get naturally more conservative as you age. Now, we get people all the time that get all caught up in this. Oh, I don't like the target retirement funds. I don't like the target index funds. This is not supposed to be your end-all be-all investment solution. This is supposed to be your start. We recommend utilizing these types of investments until your portfolio hits critical mass. When your portfolio hits critical mass, rather than a generalized solution, that's what we consider this. This is a general solution for a general population of people that are starting to invest. Once it hits critical mass, we think it makes sense to move to a specialized solution, a portfolio designed for you, for your circumstance. It takes into account your risk tolerance, your risk capacity, your time horizon, your account structure, your savings goals, all of the unique factors that pertain to you specifically. But until you get to that point, we think your number one focus should be, how much can I save? How can I put more dollars in? How can I get my money working? And ignore the noise that doesn't matter at that part of your journey.
Well, yeah, because what's going to create the easiest habit for you, or the simple habit, is something that makes inevitable wealth, and it makes it easy, it makes it attainable. And that's what I do like about index target retirement funds, is that you take away so much of the decision making to where you now focus on, how can I save more and how can I save faster to get through this get wealthy phase? Because let's face it, you will get more complicated, because we've talked about this, because Bo talked about, I was bragging about tax efficiency. Index funds, without a doubt, are very tax efficient, but you will get a point where you get so successful that now, instead of having all that money paid equally, both in your retirement accounts, your Roth accounts, as well as in your taxable accounts, you'll say, hey, let's focus on tax allocation. Let's put our growth assets in the Roth. Let's put it in our ordinary income assets into the tax deferred, retirement accounts. And then let's put the things that we need liquidity, and as well as other tax favorite things, into that after tax. That's part of the complexity, as well as adding some of those sweeteners like real estate and other diversifiers that you'll need. There's a time and a place. And that's the big thing I want people to focus on when we talk about, I don't have a problem with 3-fund investing. I have a problem with you setting it, forgetting it, and then it not having a process for correcting, rebalancing, or adjusting to your changing needs. That's where things can get a little out of whack very quickly.
Yeah, I think when it comes to investing, the very first thing that we want you to recognize is, where am I in my investing life cycle? Am I at the place where the decisions I'm making are warranted based on my financial situation, or am I getting too far out ahead of myself, right? Should I just be focusing on my savings rate and not really worried about my rate of return? Because there's a season in your accumulation journey where that's the case. When you pass that case, when you pass that point, the case that we're making is all of these different types of investing, whether it be a simplified asset allocation, or whether it be factor investing, or whether it be dividend investing, those are all tools in your tool belt, but not the solution in and of themselves. And if someone comes to you and says, hey, you know what? This is the way that you need to invest, and this is the way that you need to make money, and this is the only path to financial independence, my spidey sense would start going off. And I would start thinking through some of the reasons we've laid out why maybe these investment strategies aren't the end-all be-all that should command your dollars.
So today we covered factor investing, we covered dividend investing, of course we covered the 3-fund. What I think is interesting is, if we were taking a test for you guys right now to test your knowledge of how well you paid attention, this would be your favorite answer that I used to love when I was taking standardized tests. You check D, all the above.
I knew you were gonna say that.
It's true. I mean, that's why when I was going through this content, I was like, I hope that the audience gets where we're going with this, is that we're going to pick apart each one of these things. But the reality is that you're going to actually use all of this stuff. But there's a time and a place. And the biggest thing I try to get people to focus on is, I want you to create inevitable wealth. And inevitable wealth means that we need to make this simple. We need to make this easy. We need to make this automated. You don't have to seek complexity. It's going to find you as you reach different levels of success. So do the things and the habits and the strategies that we share, those small incremental decisions you can make today to not only improve today, but also give you that great, big, beautiful tomorrow. So do them in their time and place. Focus on what you can control, so that you're not getting busy doing nothing, not wasting calories trying to figure out which individual holding, which individual strategy. When I'm just telling you, focus on, how do you save as much as possible, get as much of that invested by living off of less than you make, and then putting it to work. And there will come a point, if you do use index target retirement funds, about the time you get to $500,000-$600,000, you're going to realize, hey, I would like to be more tax efficient. I would like to add more asset allocators. There will be a time for the abundance cycle. You can keep watching our content. We're going to show all this stuff and share it and make you easy to learn and apply this so you can build your own success. But there's also going to be that point where you're going to say, I would love to have these guys help me with the abundance cycle, take the relationship to the next level. We're going to keep creating great content. I really appreciate that we get to share this. Hopefully the chat has been good, Bo,
it's been
on
great.
the live stream, and people feel like we didn't just try to trash these strategies. We try to show how every one of these has a time and a place and a value that you can apply in your wealth building journey. I'm your host, Brian Preston, Mr. Bo Hansen, Money Guy Team, out.